Welcome to the Skeptic's Guide to Investing with Steve Davenport and Clem Miller. Every 2 weeks, Steve and Clem bring you brief investment insights you may not find anywhere else. We hope you enjoy today's episode. Here are Steve and Clem.
And gold, though.
Welcome. This is Steve Davenport, and I'm here with Clem Miller from Skeptic's Guide to Investing. And today we want to talk about all that glitters, gold. What is gold? How does it affect your portfolio? Is it something that you want to have in your rings and around your neck, or is it something you want to have in your portfolio? I think that the talk about gold is an interesting discussion because investment people will argue forever about whether it's an alternative, whether it's a personal asset, or whether it's a key to your portfolio. So today, Clem, I'd like you to try to, if you could, explain to me why you think gold belongs in your portfolio versus cash or other assets, and how do you figure out how it should be sized?
Okay. Thanks, Steve. And welcome everybody to our show today. So let me just say first, Steve, that I'm trying to stay away from all these conceptual issues that, angels on the head of a pin issues about whether gold is a currency or a commodity or, whatever it is, right? I'm trying to stay away from that. The question is, does it work as part of a portfolio? That's the only question. Does it work as part of a portfolio? And indeed, this year so far, 2025, I've had gold as a significant part of my portfolio, and it's helped in this current environment of a declining market and also volatile market. And gold has generally, over the last year to date, has generally been rising, and rising pretty significantly. And so, the reason for that, I think, quite obviously, is that gold is considered by people in the market as a relatively safe asset, safe in the sense that it is less volatile than other things that you could purchase, especially stocks. And the way I invest in gold is I invest in a gold ETF, and there are several out there. I'm not going to recommend a particular one on this podcast, but there are several gold ETFs out there, and that's how I invest in them. That's a liquid way of doing it, so you don't have to have gold bullion in your dresser drawer or under your bed. Although certainly you could have gold coins. I know people have gold coins, but I want to remain kind of liquid so that, if I ever wanted to sell some of the gold, I can, gold ETF, I can certainly do so pretty quickly. But right now, Steve, I have in my portfolio, I just looked, 17% gold in my portfolio. And
you think that's the upper limit?
I can see myself, if the market continues to have, or if it has another round of volatility, like what we saw around the time of the tariff announcements, I certainly would be inclined to increase gold. But, I think as it stands right now, I don't intend on increasing it, over the next couple weeks if things seem to be relatively stable. So, but I don't at the same time, I don't intend on decreasing it either. If I'm going to edge back up in stocks, I'm going to do so by taking money out of cash.
Yeah, I think the whole concept of gold I like a lot better than other ETFs that are based on futures. So USO is a US oil, and it's based on future contracts. And that has caused problems as there is extreme volatility because sometimes your positioning can be just a little bit off and it gets amplified. So I think that the gold ETFs that are physical, meaning there's a vault in London or in Chicago or in New York where the gold is being held. And so you are literally owning a piece or a share of that reserve in the physical asset. I like that. I like, knowing that when I own silver or I own gold, I'm owning the underlying metal. And the underlying metal, has demand from 3 or 4 sources. When I look at what's happening with gold, I'd say one of the things that is a little bit hard to fathom, but it is the way it is China is trying very, very hard to get more and more gold. They want their currency to be somewhat backed by some amount of gold. But because their economy has been growing so fast, and because they don't have their own natural resources in a large extent, they are consistent buyers of gold in the marketplace. And when I think about it going up a lot, I think about all of these countries and sovereign wealth funds who are sitting there saying, what do we do? Should we own this? Should we have more of a certain currency? And I think that there is going to be gold as a place of safety for both governments and individuals. So I like that safety nature. But then gold also has the use in all kinds of plating and other chips and other manufacture that is going to be a constant demand. And so when you look at it, and then you look culturally in India and other countries, gold is considered, a piece of their culture. And that when you have weddings or you have big events, you celebrate it with gold. And so to me, as a person in the United States, I never realized until I started to research it how widespread gold as an asset is, not necessarily as an investment asset, but a demand that is regular from generation after generation of cultures around the world. And to me, what that does is that puts a floor under it for me. That puts, I know that there's, different countries are going to do different things. But I look at the financial system and I think about people getting more and more nervous about paper assets and crypto assets. And I see that people aren't running to crypto. People are running to things that they feel more confident about. And gold is it. And the question is, not if it is going to be in demand, but how much demand? And is the price inelastic? Can it go up a lot? I don't know, but I think as long as we realize that when people are scared, they tend to do one or two things. They look for alternatives outside the market. They look for bonds and cash, and they look for gold. And therefore, if you're looking to stabilize your account, then I think it does have a place in your portfolio. The question I have is, how much place? Because I think this whole question about alternatives, bonds, and gold is they're all pieces, they all work for you. How do you decide between these choices? And then what are the advantages of physical gold? And the idea of having it in an ETF, I think, is a great creation by the providers. And I'm happy to discuss it. I think that, I'll get into a little strategy I've used for some clients who were very nervous about gold, and then they wanted to buy gold because they were afraid of the markets. And, but what is it about gold in your mind that separates it from some of these other alternatives?
We'll be right back.
We hope you're enjoying our episodes. If you are, then we'd greatly appreciate your liking, following, and sharing. Help us help others. Now let's get back to the discussion.
So, I think, we're talking about a time when we've got war in Europe, we've got war in the Middle East, We've got a gigantic trade war, which has been launched. We've got political uncertainty in the United States. We have issues with the bond markets, which we'll get into separately in another episode. There's a lot of volatility and uncertainty in the financial markets. And I think gold offers some stability with some upside, general upside. At least we've seen it so far in 2025. That really cash doesn't give you. So that's how I see. I see gold as being a stabilizer during a very difficult time worldwide, geopolitically and policy wise.
Yeah, I mean, it comes down to correlations, right? I mean, we're happy with how it performs because when there is a rush from equity assets that is risk and there is a desire for more safety, they seem to perform. I don't know what correlation you'd use in your analysis, but I think it's probably negative. I think it's probably a negative 0.4 is how I model it. But I think that it's not a negative 1. You're not going to get for every 1% drop in the technology and stocks, you're not going to get 1% increase in gold. But if you got 4% increase for a 10% decline, that's a pretty good alternative. So I like the fact that the correlation seems to hold up better than other assets.
Yeah,
I think that at the heart of it is why we're both quantitative, we're both CFAs and we both look at things and say, if it doesn't perform, then why would I add it? And I think that what it performs at is offering that relief. And I think, how do you like the idea of just having one ETF that has gold versus having gold miners and other people who produce gold?
Well, the problem with gold miners is that, first of all, it's cap weighted if you're doing an ETF, and so you don't really know if the stocks with the highest caps are those which have sort of the lowest cost production, because that's when you're investing in mining companies, you really want to look for the companies that have the lowest cost mining production. And those aren't
big reserves,
Well, but not just reserves. You could have all the reserves in the world, but it could cost too much to get them out of the ground. You want a company that is going to make a lot of money regardless of what the gold price is.
Right.
And so, a market cap weighted ETF doesn't necessarily give you that. I mean, if I wanted to look at a gold miners, what I would look at is all the major gold miners and do a lot of work to figure out what their profitability is when gold prices are low. And, honestly, I've got better stock picks I can do than looking around for the cheapest gold miner.
Okay.
That's how I look at that.
Yeah, I think that there's more security risk, and if you really just want the pure commodity, I think that's what, there's people who say use futures, there's people who say, there's different way to structure this. I think that the ETF is a great way because it is in physical item being managed and stored for you. And it's got some expense, the storage. And so the way that I've tried to offset some of that expense of the ETF cost is to write calls against the ETFs. So in doing so, I'm not trying to generate 4 or 5%. What I'm trying to do is to make it costless in terms of covering the ETF cost and also add a little bit more income. So if I can turn gold from a asset that costs me 40 basis points and add 1.5 to 2% from writing call options, now all of a sudden I've got a yield of 1. I've got no expense. I've covered the expense of the gold. And, if it goes down, I might make more than 1 or 1.5. So the volatility is something that you should always be thinking about. And that, in my mind, is another way to supplement this idea of it as an asset class.
Right.
I think that we as investors need to always be looking for, is there another way to take this asset and do something different with it? I think the idea of using options isn't always for everyone, but it is for some people that might say, I got a pretty large portfolio and I don't like this expense for this asset. I'd rather, buy the companies. That there's trade-offs. And I think that our trade-off is what's going to help the most amount of people. And I think from a skeptic's point of view, I want to be clear. Gold is an asset and it should be included in the mix of things you think about when you're trying to decide on how to find safety in a volatile environment.
Yeah. Now, Steve, let me just raise one more thing. And we always try here on Skeptic's Guide to present, sort of both sides to an issue, right? And so I'm going to present the potential downside of gold. I don't see it as having anything more than a minimal probability at this point, but just, to be clear to everybody, there is a potential downside if you look at the history of gold. And that is back in the 1930s. Granted, it was a long time ago now, but back in the 1930s, Roosevelt issued an order to seize all the gold. And he did so in order to try to strengthen the US dollar so that the dollar would have more gold backing for it. And, it was only much later on with Nixon that we went off that particular gold standard. But, there was a risk at that time, big risk, that those who held gold would essentially have all their gold expropriated. And so, that's a risk that's out there. I attribute a very, very minimal probability to that happening. But, it could happen. And it's, in an absolute currency collapse scenario, one option the government could turn to is seizing people's gold. And so I think we need to be mindful of that possibility, even though the possibility, I think, is extremely minimal at this point.
No, I agree. It's I think that the U.S. as a currency backed by gold has obviously been off the standard for a while. So I think I'm trying to find, what is the ratio? But I think it's been
The
somewhere
ratio of
around.
gold to dollars?
Correct.
Well,
The U.S. Treasury owns this much gold, and this is the amount of dollars in currency.
the money supply, yeah.
Yeah.
You know what?
So
I mean, that would be an argument. So whatever the number is, Steve, there is vastly more dollars relative to gold, ounces of gold, than there was back in the Roosevelt days. And so
I agree. I'm just saying it's
yeah. Well, no,
know,
the logic that forced Roosevelt or encouraged Roosevelt to seize the gold was because gold back in the 30s was could be a higher proportion of backing for the dollar. But today, the amount of money supply that's out there, probably would not be. Gold would probably back so little of it that it wouldn't be worth expropriating.
well, I think the number is somewhere between 7 and 10% if I look at my past research on this.
Yeah.
So I think that if you think about China is somewhere around 1%.
Yeah.
And it would take all of the gold from all around the world for China to get to 5 or 6%. And they couldn't maintain it because their economy is going to grow faster than the underlying asset can be taken out of the ground. So when you look at the size of the Chinese economy, their ability to get to a backing equal to the dollar is one of the main reasons why people say it will be very hard for people to ever adopt the Chinese currency as a replacement to the dollar.
Yes.
So I look at that relationship and say, China's going to try, but as long as the US and these other countries are the main holders, everybody would have to acquiesce to give China their gold in order for them to be, again, have a currency that is backed as much as the US is. Is it symbolic? Largely. But there is some underlying theory here that says when you want stability, you need to be able to say our currency has some backing. And yes, inflation is one of the reasons why people own gold. Inflation, because inflation, is it a perfect hedge to inflation? No. Is it a good hedge? Yes. And so that's why I think there's uncertainty, there's war, and the last one is inflation as to a reason to own gold.
Right.
And I guess I'd like to wrap up by saying well, let's say we have the average listener out there, and that listener is 65-35 traditionally. And he looks at his portfolio and he says, I'm not sure I feel I want all those bonds. I'm not sure I want all that equity. What do you think is a mix that you would put into the gold that is just enough, though it has an impact, but not too much that it takes over the portfolio?
So I would say in normal times, which and normal times would be ones where generally stocks outperform as an asset class. I would say 5% to 10%, maybe 10% max, but 5% more like it. But, as I said, today is a different environment. And that's why I'm up to around, as I said, 17% and could potentially go higher if things become more volatile.
Yeah, and I look at how inflation hurts our fixed income, and I'd say first I'd probably have 30% in bonds and 5% in gold. And then I'd say you're going to start to remove some of the equity risk. So you take 5 off of the equity risk, and now you get 10. And then I'd say you probably take your next 5 from equity. And then you've got bonds and cash and alternatives. So I think somewhere in that 5 to 15 range is a good range for people to think about. But for everyone, it comes down to, do you want to impact your long-term growth by having too much in an asset that doesn't really produce anything? As you remember, I think there was a CIO who we worked with who had, certain opinions about gold, and it wasn't a productive asset. And my point is, it's a productive asset if it fills a role in your portfolio with low correlation. So
right.
I like assets to produce, but I also don't want to necessarily get into the selection of each individual gold miner. And so I think giving people a guideline of something like 5 to 15 is probably a good space. Do you think?
I agree. You mentioned unproductive. I think that probably had something to do with the lack of a dividend yield associated with gold. And, you'd want to have less gold in an income-oriented portfolio than you would in a total return-oriented portfolio. So that's
as I said, you can add income to it if you write calls against it. So,
yeah.
I mean, when I look at bonds that were basically negative yielding, I didn't hear anybody telling me about, the lack of income that was being produced by your fixed income when everybody ran to, buy bonds when the treasuries were at 2%. So I think there's a little bit of hypocrisy in some of the people who criticize gold, because I didn't hear those same people talk about bonds being a horrible asset. So, but I think this is a good spot for us to call it here. Gold as an asset, yes, it glitters. Yes, you should own some. And the extreme example I'll use is based on World War II. A lot of people used gold. When they escaped from Germany, There were many people who sold all their assets, bought gold, and then carried it across the border and over to whatever country they escaped to. So yes, it can be a store of value. And I think we know why crypto was created. It was used by a lot of different underworld and other unsavory actors. And, the crypto has replaced one of the functions, which is to transport wealth across borders without people knowing that you have that wealth. So I hope we don't have those situations again. But there are people out there who are looking at this as a place where they want to own the physical and not just the ETFs. And I think it's really a different discussion about your personal situation and how safe you feel owning a physical asset like that. So as an investment, we like it. As a physical asset, I think you could have some of it, but I'm not sure I would be digging big holes in the backyard right now. What do you think, Clem?
I agree with that. Hold it in ETF form and ratchet it up or down depending on your perceptions of market volatility.
All right, I'll call it there. Thank you for listening, and we hope you will share and like our podcasts and let others know. And also, everyone have a great Easter weekend. Thank you.
The views shared on this podcast represent the personal investment views of the hosts. They are for educational purposes and not meant to be taken as investment advice. Listeners should consult their own investment, legal, and tax advisors. Past performance of any investments is not a guarantee for future return.